Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo video for July 26, 2016. So here we sit on a Tuesday, kind of midday during the trading session. The S&P futures are massively unchanged. What are we doing? Waiting for Yellen. What does that really mean? Ultimately, tomorrow, Wednesday, the FOMC announcement will come. The markets have taken, once again, kind of a brief pause, some summer low volatility trade. But let's step away from the FOMC announcement for a moment. And additionally speaking, there's also going to be the Central Bank of Japan will have an announcement tomorrow night. So it's a haven, if you will, of central bankers every single day. That's all we hear about is accommodative policy. So I decided, on a day that looks like a relatively slow trading day where the S&P futures are massively unchanged, the bond futures are massively unchanged, the volatility product is doing absolutely nothing. Apple comes out after the bell. Oh, excitement. Eventually they're going to have an iPhone 7. It has a camera, maybe two. Anyway, I wanted to step back from that for a moment, and I wanted to look at the SPX because something caught me as not just irregular, but as, again, something about perspective in the markets here. So time and again, I have displayed this idea between the NASDAQ, the S&P, and the Russell, and how all three of these products have been converging upon one another, and that being a definitive sign of volatility. And that is, without going into too much detail, the NASDAQ has drastically outperformed both the S&Ps and the Russell, over a period, let's say, of 5 years. However, inside of the last year, you're starting to see the NASDAQ not only underperforming, but drastically underperforming the other major indices. In fact, the Russell is the outperformer in some of the most recent trade. Now, that, again, is a definitive sign of a convergence, a longer duration convergence taking place. And what that is a telltale sign of is extreme volatility of the markets, and the market's seeing bouts of extreme volatility for a period. We're not just talking weeks or months, but of years. Well, there's another interesting thing that I picked up on, and this has to do with historical volatility, and it was something I was looking at during one of our live sessions in TheoTrade. I was looking back at historical volatility, and for those of you that have never looked at this, it's the annualized standard deviation of the past stock price movement. You're like, wow, that was an exciting, phrase over there. Yeah, well, that and a buck will get you a bag of chips. Doesn't mean anything. What it actually means is historical volatility. Think of historical volatility as actual price movement, in the S&Ps. And you can look at this on a number of underlyings, but it's really apparent on the S&P. So back over here, you're like, oh, okay, over here, why is the actual movement of the S&Ps high? Well, what we actually had was August of 2015. The markets went limit down. The actual movement of the S&Ps spiked. Falls back off. Then coming into early this year, we had some volatility. Again, the market takes off. The actual movement of the market. Again, I'm an options geek, but I also like to look back at actual movement of the market. The volatility kind of takes off. All right. In the most recent times, volatility completely abates. Then all of a sudden we see it's the British exit. Volatility spikes, stays high for a period of time, and collapses like no other. But that got me to looking at, again, historic volatility and how violent this recent move. We basically exploded, to the downside. But what I'm getting to is the actual price movement in the S&Ps was at a fairly extreme level and then completely collapsed. Literally, Literally, to put this into context, we are seeing what was 20% movement in the S&Ps, and now roughly we're at about 11, but I'll just round it to 10%. We've actually seen, a 50% decline in actual movement in the S&Ps, all in the period of about 1 week. It's pretty entertaining stuff. But that got me to thinking over here, and I decided to broaden our horizons. Because in the shortest duration, what we're meant to believe here is that volatility and actual price movement in the S&Ps is going to cease to exist. But I kept thinking about that first correlation that I've been into, and that is looking at the S&Ps versus the Russell versus the NASDAQ. And I thought to myself, every time I look at a correlation, I use longer duration time frames. So I decided to take my chart and back it out, for instance, to a 10-year monthly in this case. And again, sometimes you want to back up and get a little bit more perspective as to where you might be. And what I wanted you to see over here is, again, back in 07, extremely low actual price movement, followed by obviously 08 and 09, which is fairly and relatively extreme, even coming into 2011, 12, okay? What I'm getting to is, when I put this into a monthly chart, I was actually shocked to look at historic volatility. And the historic volatility over the past 10 years displays that we already crested through a period of inherently and incredibly low implied volatility, okay? Or I should say historic volatility, come to implied volatility next. The historic volatility was the actual movement in the market is inherently low, that we're actually on a longer trend upswing, which is exactly the time frame, okay, of our other convergence. That is, we've saw the NASDAQ start to converge upon the S&Ps in the exact same time frame. Come to that here just momentarily. So then I decided to even back up the chart more. And again, on a longer duration time frame, and I'm coming to where are we going with this? On a longer duration time frame, we're even going to go back over like a, you can even go like a 20-year monthly in here just to get a little more perspective, that the actual movement in the S&Ps is unequivocally in an upswing right now. Does this last? Well, again, the trends that we've seen, okay, in terms of actual movement inside of the S&P 500 don't often, okay, reverse trend very often. So what I'm saying is that if you take a look at a trend over here, they're long and they're meaningful. These trends are all long and meaningful. Here we're on an uptrend. Okay? So what I'm getting at ultimately with this, volatility in the markets, and that is actual price movement, is most definitively in an uptrend. And often when you see these uptrends, that's it. They actually stay with the trend and volatility continues to increase. So the reason that I'm bringing this up is this coincides with the idea that the index products themselves are converging upon one another. It's another area of evidence that we are entering into a period of extreme volatility. And it's always hard to say that when you're like, hey, yeah, but the S&Ps are at all-time highs. Nevertheless, okay, you can look at periods of time where the S&Ps were at all-time highs. You can point out to 07 over here. You can go back here at all-time highs, okay, when volatility, and that is actual movement, was at a lull. That was also an all-time high. At this period of time, though, it does appear, again, where actual movement in the S&Ps month over month is increasing, even though the last few weeks volatility has seemed to abate. Now, again, why I bring this up, and I'll go back to our original premise here. We've been looking at this idea, and this is a little bit more in-depth analysis over here. We've been looking at this idea of comparing, if you will, the SPX, okay, and we come down and, for instance, add study. We go down here to compare with, okay, and we bring up something like the NASDAQ. And then in addition to that, all right, we'll go back over here to add study, come down again to add studies, cruise all the way down to compare with, come right up here, put in a custom symbol, and in this case, I'm going to type in the Russell. And I'd like to take you through all the steps of how to actually build effective comparison charts. In addition to that, under style, I want to make sure to compare apples to apples, so I put line chart to line chart. Now again, this is the 3 major indices over the last 9 months. Take this back in time, all right, approximately, and again, we'll go to in this case, 10-year monthly of the 3 major index products. It's going to look vastly different, where again, if you've never seen this before, something I've been talking about extensively, really since the inception of TheoTrade, up top here, clearly we have what? The NASDAQ, it's the NDX. Neck and neck down here, we have the SPX, okay? And of course, the Russell. And as I say, they're neck and neck. Now, what the convergence happens to be is that the NDX coming down to the SPX, when those convergences occur, we hit bouts of extreme volatility. Well, again, clear the chart here for just a moment, and we'll take a look at the exact same comparison, all right? For instance, on a 1 year. And when you start to see on 1 year, take a look. That's the S&Ps outperforming the NASDAQ and outperforming the Russell. And in even a shorter duration, okay, on a 6-month chart, you're actually seeing the Russell outperform both the S&Ps and the NASDAQ. So it's pretty definitive that over the last 6 months, we have been in the midst of the beginnings of a more extreme volatility environment. We are now actually seeing some definitive confirmation on historical volatility in the SPX. So let me go ahead now and add this study back in. So we're going to go back down to studies. We're going to go add study over to volatility studies, come up here to historical volatility. And once again, what I'm trying to elaborate on is the actual movement inside of the S&Ps dipped off hard. But again, brought up on a much longer duration. All right, brought up on a much longer duration, you'll actually find out that on a month-over-month basis, volatility and actual movement inside of the S&Ps is doing nothing but picking up to the upside. Again, believe a convergence of the major index products is underway. The NASDAQ is likely to fall harder than the S&Ps and the Russell, but make no two ways about this. These bouts of volatility, in order for the NASDAQ to come down to the S&Ps, okay, and the Russell, we're going to have to hit bouts of volatility where all 3 major index products sell off. What you will get, though, is the NASDAQ likely selling off harder than both the S&Ps and the Russell in the midst of these bouts of volatility. And again, think about this on a much broader time horizon. We're not talking about days. We're looking at months and years of volatility ahead. So again, when I think everybody gets myopic and they're worried about tomorrow and the FOMC announcement, sometimes it's nice. Take your chart, broaden your horizons a little bit. Stop looking at the next 3 months, the next 6 months out there. When I say broaden the horizon, realize we've had accommodative policy now since 2008 to much of what? Nothing. All right, that Japan has been doing accommodative policy and monetary easing, all right, for 20 years, and we've seen much of nothing. One thing, again, that is definitive in this marketplace, though, is we're seeing actual price movement starting to creep up. Thanks, everybody, for joining us here at TheoTrade. Get ready for the coming volatility. Join us all throughout the course of this week as we discuss volatility, probability, and really some great trade ideas, surrounding some of the earnings announcements coming out, obviously the FOMC announcement, and much more. Thanks, everybody, for joining us. Have a great evening. Bye-bye.